Here we go. Let's do a review of round two. By the way, these reviews will get probably shorter as the semester rolls on, as you guys are understanding it a little bit better. I'll touch on fewer things that I deem to be important because hopefully you guys will have entered those into your memory banks and I don't have to touch on them. But in any event, for round two, again, I kind of always start at the top, but there's things that I look at and things that I kind of skip over and do differently and things that I find important. And those things change very much so from round to round. So, here we look at sales. Erie and Baldwin certainly led in terms of sales and also then led in terms of earnings before interest taxes, and Erie led by far in terms of income. Well, this one's maybe a little tougher look. Okay, I mean initially, and the first question on your assignment number one had to do with contribution margin basically and SG&A to sales. And so at first glance, I would say, I'll bet you Erie had a higher contribution margin. Sure enough, they did, and significant 4.7%, which would attribute or cause quite a bit of that difference, maybe, except that in this case, Baldwin had a much lower SG&A to sales. Okay, so you want SG&A to sales to be low. That doesn't mean you shouldn't spend money there. It means that you want to be as efficient as you can with your money to generate sales. Again, the customer buying criteria is kind of a key there. So anyhow, that's 2.3, 2.6, and these are obviously both related to the sales number. So they're 4.7 better here, but 2.6 worse here. So about 2%. Yeah, that's still about $3 million, before tax, and this is an after-tax number. So there were some other things that contributed to Erie's profit lead, over Baldwin in this case. Just looking at the two, the fact that it had a little more sales, sure, that had something to do with it. There's no question about that. That probably most of it. I think we'll see down below. There's probably one other thing that probably contributed to that, if I had to guess. We see shares outstanding. Interestingly, Team Ferris has gone the alternate route. Team Erie has the same amount of shares outstanding as what you guys started with, and every other team up here has more shares outstanding, whereas Team Ferris has fewer shares outstanding, which in this case would have made its, going back to that again, assignment number one, would have made its earnings per share higher. Okay, roughly 5%. Okay, and that's just off the top of my head. I'll probably ask you to calculate some of these in the future, and we'll get down to brass tacks then. But in this case, it's roughly 5%, right? Because they dropped their stock about 5%. So that'd be what, 24 cents in earnings per share. Doesn't seem like a lot, but it's an awful lot. Okay, an awful lot. So when you're looking at it as an investor, it really is. Okay. This is interesting, and I didn't say this at the top, but looking at it once again, I'm finding this contest to be somewhat unique in that all teams are doing relatively well, especially for the practice rounds. Usually by this point in time, I see one or two teams that have collapsed. They again made an error in judgment, one bad decision, didn't check their final decisions and had a collapse, and we're not seeing that. All the teams are doing relatively well, and we see that stock prices, everybody's going up, everybody made some money, nobody's losing some money. Kind of interesting. Either that means that every team has decided to take the middle road and doing kind of okay in doing that, or no one team has really stepped out and been really aggressive. Now, I'll also point out though that this is one of the few times where I have enough teams that it's all 6 teams are being played by humans. Often I will have one or two teams, in a little smaller class, one or two teams where the team is run by the computer. Generally speaking, in the practice rounds, the computer does real well. In the competitive rounds, the student-run teams come back and do a lot better. What an interesting stat this is. I know I'm coming down, I'm kind of jumping in the cash flow. Everybody made some money, so we see that. The one other thing that I guess I wanted to point out that did make a difference, and I can see it here in terms of profit. Now, in terms of cash, we adjusted up for Baldwin, but Baldwin had a lot more depreciation than Erie. 2.5 million more in depreciation. So that was one of the other factors then that contributed to Erie's profit lead would have been depreciation. But the inventory, let's look at that. Every team had a positive number for inventory. Okay, that doesn't mean they made money. That means that their inventory was reduced. That's all that means, is simply that their inventory number was reduced over the prior year, and that had a positive impact on its cash. Okay, because we're talking about just the cash flow statement up here. Okay, huge. Okay, but that's a big deal, and we'll see that later and what happened there. It's kind of interesting. Accounts receivable, not a huge factor there. We would expect that teams that sold the most would have a big increase in accounts receivable. I'd worry about Ferris and Andrews. Just glancing at that, they had actual reduction in their accounts receivable, assuming they didn't change their accounts receivable policy. Plant improvements, look at that. A positive number. What's a positive number mean? I'm going to leave that one out there because I might ask that question at some point in the future. And on the other hand, Baldwin with $40.8 million spent in plant improvements. That's why the depreciation number's higher. Okay, so you can look at those two and you get a sense of kind of what's going on. One affirms the other, I guess you would say. So that's interesting. Other teams didn't spend so much at all. Erie virtually none. Okay, Digby a little bit. I'd want to know what they spent their money on and if that was a concern. And that it is, I think, one of the questions that I have on the assignment for next week. Okay, so net cash from financing activities, not a big deal, but interestingly, each team had a nice change in cash, with the exception of Baldwin. Theirs was small, still positive, and they had positive last round, and so nothing wrong with that. In fact, I would say Baldwin's cash management was way better than every other team, and I'll tell you why in a second. Considering they spent that kind of money on plant improvements to still have a positive cash balance, that's a pretty good deal. Okay, and they finance some of it, which is, you're going to spend that much on plant improvements, a little long-term financing is not a bad deal. Okay, we get down to cash and we say, look at all the cash. That's an amazing amount of cash on hand for the second round. An amazing amount of cash on hand when you add up all the teams. What do you got? 48, 114, 124, 132. What's that, $190 million in cash between the 6 teams? Ton of cash. Okay, so what's going to happen with the cash? Why did I say Baldwin is probably a little better off because of their cash, the lower cash or better cash management, even though you get bonus points for cash flow. Remember, that's a very small, very, very small item. Okay, because too much cash can be a drain. Okay. And let me tell you just briefly, and this will come up on questions in the future for sure on homework or on assignments. Okay, Digby, for example, has $56 million in cash. It has total equity of $78 million, right? Let's say they got rid of $50 million of that cash. Okay, and how do you get rid of it? Well, there's things you could do. Okay, to get rid of it, like pay a dividend or buy back stock or some combination thereof. And so, but let's say you could get rid of $50 million in cash without affecting anything else. Your total equity would go down to $28 million. And in a lot of cases, from a banking standpoint, you'd say that's kind of risky. And it's true. Their liquidity ratio, not their liquidity ratio, I'm sorry, their debt to asset ratio, I forget what they call it in this game, would become a little bit frightening. Okay, it would become a leverage ratio, that's what they call it in this game. It would become a little bit frightening, but can you imagine what that would do to its ROE? Okay, what would that do to its ROE? And that's a good question I'll be asking in the future. If if it reduced its equity by $50 million, its ROE would have skyrocketed. Okay, and you guys will know that part of the question in the future. Of course, I'll probably have you do some calculating. So, again, sales variable costs, again, we don't worry about those because they're a component of the sales. Okay, and I'm more worried then about the contribution margin up above. Okay, again, it's easy to say, right? Erie and Baldwin had similar sales, and Baldwin had higher variable costs, even though they had less sales. What's the reason? The contribution margin, right? Okay, and so that's what I'm more interested in probably in this case when I'm looking at these industries anyhow, is taking a look at that contribution margin. Appreciation, yeah, pretty high, which is a result of that investment that they made, or that it made. Okay, SG&A to sales is kind of interesting. Again, we look at the efficiency factor up there. Okay, Baldwin was way more efficient than Team Digby. Digby spent $16 million, and Baldwin spent $11.6 million to have roughly the same amount of sales. Okay, you know, I'm talking about Erie. I think I said Digby. I'm sorry, and I meant Erie. Okay, so Baldwin was way more efficient than Erie. Okay, way more efficient than Erie. You know, Digby, Andrews, you know, similar. Well, you know, Digby was way more efficient than Andrews. They spent $4 million less and generated $8 million more in sales. Huge. Okay, those are huge factors, right? Again, those are reflected up above in that SG&A to sales number. So while it's good to look at these absolute numbers kind of in this case, it's important to look at them in terms of the SG&A to sales, probably more important. EBIT, we see interest, we like to look at. Baldwin, right? They borrowed some long-term money, made some plant improvements. Maybe they have a plan. Okay, maybe that's a part of their strategy. That could be. You know, Digby's not far behind. Digby might have made they made a few plant improvements this time. They might have made some more last time. I'd have to go back and look. Taxes are what taxes are, and it's a reflection of how much you make, right? And net profit we saw up above. Okay, again, I slow down here. Okay, we had in the first round, at the end of the first round, we had way too much capacity. Okay, and in the second round, we have even more capacity. Okay, we have so much capacity, it's unbelievable. I find that kind of unique in this game that we're doing here, is that just an unbelievable amount of capacity that you guys have. Again, remember that if you're blue one, let's just rough it here. Erie's got the capacity to make 6,000 units. That's in the first shift. Okay, if Erie wanted to use both shifts, Erie could make 12,000 units. Okay, Erie's making 4,500 units. Okay, so there is, what's that, 7,500 units of capacity. It'd be 7.5 million, right? But 7.5 million units of capacity that are sitting idle. You know, is that an expense that shows up? That's an expense that shows up in the equity of the company, right? You've got more fixed assets, you've got higher equity because you're sitting on that. It's an expense that shows up in your interest in all likelihood. You're either borrowing money or not paying back money or losing out on interest income. Okay, it's an expense that shows up because you've got to maintain that capacity, and on and on and on. And when you do R&D, you're making changes to that much more capacity, and I believe your R&D expenses are based on the amount of capacity that you have. I might have to look at that to make sure, but I'm pretty sure that's the case. Okay, so we have easily 2 times, it's way more than twice the capacity that we need, okay, as an entire industry. This is interesting, you know, and I just glance at it, and I'll scroll down here so we can see virtually all of them. That's all the inventory that you guys have. Those 3 teams in the high end, and that's it. Everything else sold out. That's kind of unprecedented. I haven't seen that, especially in the second round. Interesting. So everybody I guess y'all, maybe you took my advice. Y'all made your forecast, and then y'all kind of cut back a little bit, in case, okay, in case things didn't go so well, and it actually made everybody a lot of profit. Now, a lot of money got left on the table too. Okay, a lot of money got left on the table, and we'll see that a little bit later when we go through a few of these things. Interesting, we did see. Team Andrews had an interesting number, I think, for its plant improvements up above, and we do see it made some changes here. Might be interesting to note what those changes are. Team Baldwin, your question was, your assignment for this week's going to be about Team Baldwin, so I'm not going to really talk about that. Chester doing some things with its capacity as well. Digby has changed its capacity a little bit. Erie only to the extent of a new product. And about half of you got that correct last time. The money that Erie had spent last time was all about creating a new product. Okay, it hasn't changed its capacity here, and to my knowledge, I don't think it's changed its automation. Each of those would be plant improvements. Okay, but I don't think it's changed either of those. Ferris has made some interesting changes both in automation and in capacity. Okay, and so quite interesting there. I bring those up, and if you're not Team Ferris, you're probably saying to yourself, why the hell do I want to look at theirs? Believe me, you want to know what the other teams are doing so that you know what the competition's doing. That will help you tactically, okay, to pursue your strategy. Okay, it'll help you very tactically. I mean, it's huge. Look at that. The traditional industry, the demand was 8,800 units, and we didn't meet it. Okay, so we didn't meet demand overall. Remember last round I said wasn't a huge deal. In this case, it's a huge deal. Okay, Chester left a lot of money on the table. Okay, Chester left. One of your questions this round will be regarding that. It's not going to be the traditional end here. I think it's in the low end, but this is just rough. Chester had the potential to sell 30% of the market. It sold about 22%, so it left about 8% of the market, which would have been about 700,000 units that it could have sold for $25 a unit or thereabouts. What the heck's that? 15, 16, 17 million dollars more in sales that Chester could have had. Okay, left it on the table. Okay, and that gets you guys running out of inventory. Well, that's not a bad thing in some senses. You made a little bit of money, but that's a lot of money to leave on the table there too. Okay, Baldwin kind of took advantage of it, as did Digby, and as did Andrews to a small extent. Ferris left a little money on the table as well. And you're going to have a question where you're going to do a little computation, and I'll kind of show you that maybe when I get to the assignment. In the low end, Chester left even more money on the table, right? Could have had 21% roughly. The market share had about 8%, so left about 13%. Ferris left a ton of money, right? Could have had about 27%, had about 15, so left about 12% of the market on the table, right? And you're talking 11 million, so what's that? Could have sold another million or so another 20 million in sales probably that those two left on the table. Andrews lost out, Baldwin lost out, and Team Erie, they didn't lose out, they gained. Okay, Team Andrews, Team Baldwin, and Team Erie gained hugely. Team Digby a little lesser, because these two teams simply didn't make enough. Okay? They had the goods, they had the customer demand, and they didn't make enough. Now they got a bunch of ticked off customers. Hate ticked off customers. In the high end, at least we met demand, but some interesting again statistics. Andrews left money on the table. Erie left a little money on the table there, and again Baldwin and Chester were the beneficiaries in this case. So Chester benefited in the high end. They gave up money in the low end traditional. Ferris again left money, lots of money on the table there. But remember, Ferris was making some changes in their high performance and size categories up above. We saw that in the production. So Again, look at everything, try to put these things together. You might be able to figure out what Ferris is doing. Okay, Digby maybe as well, you know. Didn't quite meet demand in the performance area. Again, Baldwin was a huge beneficiary. Ferris is the team that left the most money on the table. They had huge potential and just didn't meet it. Okay. And in the size, and I'm taking a quick look again. You guys should analyze these a little bit closer because you should get down into here. This is a difficult round to really compare products, and I say that because everybody sold out in just about every area except the high end, and so it's difficult to look at and say, why did this product sell more than this product? Well, probably just because they made more in this particular round. You know, I guess you could, if you're going to do that, and you probably should, you know, why did Chester have a bigger potential here in the size? Okay, why did Chester have the biggest potential? Had a potential to have about 28% of the market, only ended up 21% roughly. Revision date pretty early in the year, that's a big deal. Performance and size coordinates were off a bit, you know, so it wasn't really positioned all that well. Price cheap, okay, and good MTBF. Okay, age was fairly low, fairly good, and it spent a little bit of money. Look at Fume, you know, Fume. That's interesting, you know, that they even had that high of potential, even though it spent no money. Of course, it has a poor, relatively poor, I guess, December customer survey. That's kind of interesting, isn't it? Spent no money, and yet, okay. Probably had a lot of those sales coming out of the gate, would be my guess, left over from last year. Maybe had a good customer survey or something, December customer survey. Okay, one of your questions is going to be about the number of units that Chester didn't sell and could have in the low end, and that we're going to look at this chart here. Okay, and in the low end you would compare, and I'll go over this again on the assignment, but its potential was 21.1% of the market, and its actual was 8.7% of the market. So what's that? 1.3, about 12.4% of the market that Chester could have had and did not get. Okay, and we'll calculate maybe how many units that is. Then you get to the bigger perceptual map, and again, I have a tough time looking at the smaller one in the different segments, but this one gives me a little better picture of maybe what's going on. You know, I start to get an idea maybe about what the strategy is for the various teams, and it's not 100% clear by round 2, but I start to get a bit of an idea, okay, at least of what the strategy is. You know, it looks to me like Team Erie is trying to, you know, stay out in front here a little bit, so, you know, maybe a differentiation. I'll have to admit Ferris has me a bit confused with what was on the production analysis and where they're sitting here, okay, on the perceptual map. Team Digby's definitely doing something obvious, okay, and so I can kind of tell, I get a pretty good idea. I combine this with some of the information that I see up above, especially in the production analysis. Gives me a decent idea of probably, I don't know, I could probably, with just that information, tell you 3 or 4 of the team's strategies and be fairly accurate. HR, I think you guys had the ability to make HR decisions, and it doesn't look like anybody did anything of any consequence, I should say. This is the needle that gets moved right here, is the productivity index, and it didn't get moved, okay? And roughly speaking, you know, if this productivity index went to 110%, you would save 10% of your labor cost. Okay, for most of you, your labor cost for this round, it was probably $30–40 million, so you could have saved $3 or $4 million. And those savings would be ongoing. You know, they would last you, excuse me for a second, shut that off. Those savings then would continue for each of the next rounds, and in the practice rounds that's only a few more rounds, but in the competitive rounds maybe that becomes even more important. TQM we haven't done yet. And so that's kind of it. So overall, and I'll take a look at the winter thing here in just a second. But overall, so what do I think? Well, I think what I said a little bit earlier, that most of the teams here are being fairly conservative. No one team has really, no one team has even made an effort, I would say, to aggressively pursue its strategy. I'd give some thought to, maybe even making deductions. If I did, I'd have to do it across the board, though, so it wouldn't make that much difference. Teams, and this is historically true for the last 5, 6, 8 years or whatever I've used this game to teach this class, but for whatever reason, okay, teams don't associate the strategy with some of the simple things that it takes to pursue that strategy without being reckless. And what do I mean by that? If you're a low-cost strategy, what do? You find out the things that allow you to make your products at a lower cost. Okay, you have to be careful a little bit, okay, because of the whole thing about the capacity versus the labor. Yeah, you might, if you're using a second shift, you're going to be paying time and a half, okay, but which one's less costly? That one's a little bit difficult. Some of the other ones are not difficult at all. The investments and things that you would make to try and lower your cost. And so if I were running a low-cost strategy, I'd be looking up in the guide. I'd be paying attention to the decisions. There's the little red triangles that give you little pop-ups, on some of your decision things that help you out with some of those things. I'd be looking for everything that I could do to cut costs, and then I would do that aggressively, not recklessly, but aggressively. Okay, if I were differentiating, then I would look at the things that I need to do to differentiate my products, okay, from the other products. And nobody's doing that in a big way. Nobody's really differentiated their products. Nobody's really done anything yet to what I would say to cut costs, not in any meaningful fashion whatsoever. And so that's why I say I think we're fairly conservative, and maybe that's why nobody's breaking from the pack. That's why the pack's all pretty tight. That's why everybody's making a little bit of money. And, maybe the game will go on that way. And that's kind of okay. Maybe one team will decide they want to stomp the other teams, however, and make some changes. And that will force everybody else's hand then, if that's the case. So we'll see as it goes on. Let's take a look at who the winner was for this week. We're on practice round 2. By the way, if you take a look at the spreadsheet, you'll see there's numbers in here. That's from prior semesters, so don't pay any attention to it. Just go to the one where we're at, which is practice round 2. Make it a little bit bigger here, maybe. Okay. Again, just data that I copy and paste into here, so I can get an idea. So that I can make my computations, and the computations came up with this. Okay, earnings per share. Erie was the clear winner there. ROE, once again, Erie was the clear winner. Contribution margin, Erie had the highest contribution margin. Stock price, again, Erie made the biggest change. Profits, it's almost looking like a clean sweep until we get to cash flow. Andrews made a huge, remember they had a emergency loan big emergency loan, and so Andrews made a big jump in improving its cash flow. It's probably why it won that one. Strategy, I didn't take any away. Look at that, no deductions for emergency loans, no deductions for leverage, a couple of deductions for working capital. Baldwin and Chester had deductions for working capital. I'll come up and see. Chester would have been pretty close. 20 million is kind of the minimum there. Baldwin's a little bit low. What happened there? Again, they made a huge investment in plant improvements, right? And so that's taking in oftentimes short-term assets, be it cash or whatever it is, and investing that into more long-term assets. And working capital is a short-term equation, right? Total current assets minus current liabilities. And so that's probably the reason. Again, maybe not a bad thing, maybe not bad at all. Maybe that investment will pay off, but it does entail some risk, and so that's why the penalty. So almost a clean 100 points for Team Erie. Pretty good margin of victory, especially for a game that's relatively close in terms of profits and those types of things. So it's interesting. And again, I'm not seeing teams making a lot of movement towards their strategies. So I'll be interested over the next few rounds. And this is the time to do it in the practice rounds to test those strategies. So see what happens. I'll sign off for now. I'll do a couple other little videos on this last week's assignment and then this week's assignment. Thanks.